Hi everyone, welcome back to the audit and attestation class. This is a new topic and very interesting one, subsequent event and subsequently discovered fact. So in this class we'll be covering in detail about what are the subsequent event and what is subsequently discovered fact in detail. So let's dive into for more detail. Now we are jumping into subsequent event and subsequently discovered fact. So first one is subsequent event and then we jump into the subsequently discovered fact. So we touch base this topic yesterday as well, right? I know what topic we were discussing, but we touch base on the subsequent event and subsequently discovered fact as well a bit. So it's same, or you can say more detail about what we have discussed yesterday. So can you all see my screen?
Yes, sir.
Cool. Okay. Subsequent events and subsequently discovered fact. Subsequent events are those events which are in the period from the year end to the report signing date. For example, your year end is December 31st and your report signing date is 28th of February. So any event occurred in between 1st January to 28th of February for which there was some, you can say, some leg is already pending in the previous year or in the financial year, and which will be having conclusion or impact in the on account of subsequent event which has happened before the signing up date but after the closure of the financial statement. For example, you already have some litigation pending, right? So during the year, let's say, for example, income tax department has issued a demand order, and then you have, let's say, hearing for that against that demand order in, let's say, probably in January, right? And in February, let's say it got concluded that you need to pay this much amount as an income tax liability, additional liability or penalties. So in that case of scenario, so maybe on 31st of December, when the picture was not clear to you, you might have estimated something, whether to disclose in the financial statement or accrued in the financial statement, or if you are very confident that you're going to win, then probably you might have not disclosed anything in the financial statement. But let's say in January you had a hearing and in February it has got concluded before the signing up date and you are supposed to pay, let's say $50,000 or $100,000. So that's a conclusion of, you can say, the probable event which was existing already in the during the financial year. So there you'll be taking the impact. So there are two kind of things. One is adjusting event, second is non-adjusting event. So we'll be discussing more in detail on that as well. But if the event was already exist before the financial year and it has been concluded or it has got some updation in subsequent to the year end but before the reporting date, then you'll be considering the adjustment wherever needed, right? If there is some new event has been happen in the month of January and February, so there you need to see whether the disclosure or adjustment required or not required, right? So for example, like till December year end, everything was going well, but there was no such and in January, let's say one of like customer has raised a complaint or raised a case against the company, right, which was not exist at the time of like year end. And even though like for the sale which you have made in January, for that, let's say consumer has made a case against you in the month of February. So that is like kind of, even though it's a subsequent event, but it's not a reportable event because it has nothing to do with the previous financial year. So that is something you need to be conscious about, or you need to keep in mind whether all subsequent event may have impact or there are certain subsequent event which will be having impact on the financial statement. So two things: if the subsequent event has been happen in future period and the impact of the same is also in the future period, then it is not a reportable event. But if the event exists on the balance sheet date or before the balance sheet date, but it has got resolved or it has got any update or it has reached to some conclusion subsequent to the balance sheet date, then it is a reportable event. So in reportable event also we need to see whether it's an adjustment required in the financial statement or it's just a disclosure required in the financial statement. Right? Make sense? Yes,
Yes, sir.
it looks very okay. So there are three things you need to keep in mind for the subsequent event. One, whether it's material or not, right? If it is not material, then I think you should not be worried about it, right? Second thing, whether the event is reportable event or not reportable event. Not reportable event is basically which may not have material impact on the existing financial statement for which you are making the audit, right? Reportable event are those events which may have material impact on the financial statement for which you are conducting the audit. So now coming to reportable event. Within the reportable event, there are two categories. One is where adjustment is required in the financial statement. Second, where only disclosure is being required, right? So we discuss in litigation claim and assessment topic the level of probability, right? If the probability of losing is less than 20%, then you will not be disclosing. If it is between 20 to 50%, you will be disclosing. And if it is more than 50%, then you will see whether the amount is estimatable or not estimatable. If the amount is estimatable, then you will be making adjustment. If the amount is not estimatable, then you will be making only disclosure, right? Same thing applies over here in the subsequent event as well. So let's understand theoretically. High level I have shared what is subsequent event. Let's get into the theory, and we try to crack one by one in the respective category of the subsequent event. First one is, if you see the definition, a subsequent event is an event or transaction that occur after the balance sheet date but before the date of report. That means after 31st December but before the report signing date, that is 28th February in our example. That has material impact on the financial statement. Keep in mind, material impact only. We do not consider all changes. We do not consider all subsequent event. We consider only and only material subsequent event, right? CPA must review the subsequent event. It's a mandatory audit procedure required to be performed, or mandatory review procedure also required to perform in the review engagement. So this is something, subsequent event testing is a mandatory procedure. So what are the type of subsequent event? Reportable or not reportable. First, let's understand what are not reportable subsequent event. For example, if you are changing any product line, or if you are changing any service line, if any new product line is being added, if any new service line is being added. For example, till December, you are selling, let's say you are an FMGC company and you are selling, you can say, dairy products. So you are selling dairy product, and in next year you want to add, let's say, beauty product as well, right? For example, let's say Patanjali. So you might be selling desi ghee, butters and everything, and later on in next year you want to add the beauty product as well, right? So that's new product line which you are adding in the next year. It has no impact in the current year financial statement, right? So that's the reason these are not reportable event for the current year financial statement, as it will not have any impact on the financial statement of the current year, right? If there is in future any change in management, any, let's say, new director has been appointed, new CEO has been appointed, new CFO has been appointed, right? Any loss of the customer in future, right? Unless and until there is any pending amount, unless and until there is any chances of provision for bad debts for the lost customer. So if there is any amount pending from the customer and which customer you have lost and your recoverability is an issue, then it will be a reportable segment. But only generally a new customer you have acquired, then it is not a reportable segment, right? Any new production facilities or location you are opening, so those are not relevant for the current year financial statement or user of the financial statement. So that's the reason those kind of information are good but are not reportable. Make sense? What is not reportable? Once you understand what is not reportable, more than half of your life is easy. Any doubt what is not reportable?
No, sir.
Now coming to reportable. Reportable items are those items which will be having impact on the current year financial statement. So here two categories. One is which require adjustment in financial statement. That means which required you to accrue certain amount or book certain amount or post certain journal entry. Or there are certain event which require only disclosures, right? First one is when adjustment is required, when there is a reportable event and it required an adjustment. So first, condition exists at the date of balance sheet. So that condition for which you are making an accrual was already exist on the balance sheet date or before the balance sheet date. For example, loss of receivable resulting from bankruptcy of the major customer. So for example, in January, you got to know your major customer is going to get into bankruptcy and you have, let's say, $1 million due on him, right? In that case of scenario, you need to book the provision for doubtful debt. So that's a reportable subsequent event and require an adjustment in the financial statement because you know in future you are not going to recover the amount from that particular customer, right? Second is settlement of existing litigation. For example, your customer has made a litigation or claim against you. And now in the month of January, you are getting into arbitration and finally setting the amount with the customer. So if the amount is being settled with the customer subsequently, for which like you have already made the sale in earlier period, that means you know now the amount is concrete. You need to book that amount. You need to make the adjustment of that amount, right? Third is determination of an estimated amount. For example, any litigations or maybe let's say any tax assessment is happening, right? At that point of time, your legal counsel has estimated that the penalty might be $100,000, right? And on based on the best estimate, you have booked the provision of $100,000. And when you get into a final settlement with the tax authority, it has been concluded for $50,000. So in that case of scenario, you'll be reversing the provision of $50,000. And if it has been concluded at $150,000, you'll be booking additional liability of $50,000. Make sense? When things got concluded between the financial statement year-end date to the report release date, in that case of scenario, you'll be making an adjustment entry. Make sense? Simple?
Yes, sir.
Now coming to the disclosure, which is gray area basically. So in disclosure, condition did not exist at the balance sheet date, however occurred after the balance sheet date, but before the report release date. For example, sale of bond or capital stock, any merger or acquisition, any fire, any flood or disposal of asset, right? So here on the balance sheet date, you have not entered into any merger agreement. But in January, you entered into a merger agreement or acquisition agreement. So that's a significant event, even though it does not have impact on the number. But user of the financial statement would be interested in knowing what exactly you are acquiring, with whom you are actually merging, what assets you are disposing of, right? And for example, if let's say in the month of January, there is a flood and your 50% of the capacity has been lost in that flood. So user of the financial statement would be interested to know that information. So that's the reason those information are required disclosure. Make sense?
So the disposal of assets, so the significant ones or
Significant,
every
yeah.
disposal?
Yeah, no, all material things only. Immaterial things we should not be worried.
So basically material on the basis of materiality just calculated last year.
Yes, yes,
Right.
absolutely true. Right? So subsequent events are of two types, reportable and non-reportable, right? Non-reportable, which for which like user of the financial statement does not make much difference generally, if principal you think. Reportable are those for which user of the financial statement are interested to know. In that, adjustment would be where condition or event was already exist before the balance sheet date and it has got resolved or got an updated information after the balance sheet date but before the signing date. But disclosure events are those events which has been occurred after the balance sheet date but are significant and important for the user of the financial statement to know about it. So those items are required disclosures. Right? So audit procedure, what all audit procedure you'll be performing to identify the subsequent event and testing those subsequent event. First is like cutoff procedure. How many of you have audit backgrounds? Have you heard about cutoff procedures for sales, purchase, cash,
Yes.
and bank? Right? What we do in cutoff procedures?
Sir, we take 15 days prior or 15 days after the year end of the client, we take their samples and we try to test them whether it has been recorded in the correct period or not. It all
Yeah.
depends on how usually the shipping is done for the client and how much time it takes. So if it's like usually if it takes 10 to 15 days, we'll take 15 days cut off. If it only takes 5 days, we'll try to take cut off of 5 days and pick our samples to make sure that everything is like all those transactions are recorded in the correct accounting period.
Yeah, yeah. Anyone else would like to add or share your experience? Any abnormalities you might have noticed in cutoff procedure? Ayush, Gurmehar, Sanchit, Jaspreet, Nimisha.
No, sir.
You guys wants to
Not
share any
really.
experience? Okay. So cutoff procedure we performed generally at the beginning of the year and closing of the year based on the normal turnover days. So in how many days like sales turnover take place, right? If it is 5 days, then you take 5 days prior and 5 days after. If it is 10 days, then you take 10 days prior, 10 days after, right? And you test certain invoices, or you can say certain transaction of the sales, to understand whether the transaction has been recorded in the correct period in which they are supposed to be recorded. So in the current year, transaction should not be reported in future year, and future year transaction should not be recorded in the current year. That is something you need to ensure when you are performing the cutoff procedure. Second is subsequent collection from receivable. So whether your receivable are good or not, how do you get to know? By testing the subsequent collection, right? For most of the time to the receivable, first procedure we perform is the confirmation, right? Second procedure we perform the subsequent collection from those receivable to make sure the receivables are good. Because generally it take 1.5 or 2 months for complete the audit, right? And on an average, like company do have 15 days to at the max 60 days credit period nowadays. There's like very less company which have like more than 60 days credit period. So that means most of the debtors, they will recover before the signing of the report release date. So it's always a good to test the subsequent collection from the receivable. Third is subsequent material payment. So this is also very important, which we perform to identify the subsequent event. So in future, for example, from 1st January to 28th February, we'll see what all material payment the company has made and try and understand whether those payments are relating to the future year or to the existing previous year. If those payments are relating to the previous year, whether the company has made the appropriate accruals or provision for those or not, right? If the company has not made provision or not accrual, then we will request the management to make the accrual and provision for those payment. Let's say in the month of January, company has made a payment of, let's say, $50,000 for settlement of a liability, right? Whereas the liability in the balance sheet was $100,000. So here it's a gain of $50,000, right? Whether the management has recorded that gain or not, it's a reportable event. Make sense? Yes, no?
Yes, sir.
Yes, sir.
Right? D point is read and review interim financial statement. So sometime for a private companies or maybe not listed company, not a public company. So you're like generally you perform the audit in the month of like March to June generally, because like first generally like CPA firm target to finish off the audit of big and listed company, right? And after that they turn their resources to the you can say non-public companies, right, for a better utilization of their resources throughout the period. So in that case of scenario, there might be possibility that private company you are might be doing audit in the month of April or May for the year end December. So they may have like interim financial statement for the quarter one. So you need to review to understand if there is any subsequent event which has been considered in the Q1, right? And then you will be reviewing the minutes of the meetings as well for the subsequent period for the board of directors, shareholder, or any other committees of the director. You will be performing inquiry with the management about the contingent liabilities and commitment, significant change in any capital stock, long-term debts, working capital, or any unusual adjustment they have made in the subsequent period. Last G point is inquiry with the legal counsel. You need to perform the inquiry procedure with the legal counsel for the subsequent period as well, whether they come across with any update in those legal matter which they are dealing, or any new legal matter come into their attention during the subsequent period. Next is review the records of unusual transaction like manual journal entries. Obtain a representation letter on the subsequent event as well. So these are audit procedure you'll be performing to test the subsequent event. Make sense?
Yes, sir.
Any doubt here?
No, sir.
Okay. So last topic of the day, subsequently discovered fact. What are the subsequently discovered fact?
Facts which were already there, but we discovered after the balance sheet.
Yes, absolutely true. So for example, like some customer has already made a claim, already filed a litigation against the company before the balance sheet date, but neither company has informed us nor we got to know before the year end, right? And after the year end, we got to know that claim that customer has got into the higher level of authority for the litigation matter, and the claim is now serious. So that is called subsequently discovered fact. The fact was already exist there, but it has been discovered subsequent to the balance sheet date to the auditor, right? So first,
Oh, so like we discussed about the sales example in the subsequent events. Like if sale is in the month of January and complaint was raised in February before the balance sheet, before the signing date. But what if the sale is in the December, which is in the reporting period, and
that is
complaint has been
subsequently
done in January?
discovered fact.
Okay, it will, because it is reporting in our period.
No, sorry, say that again. If sale is in December, but complaint has been raised in January.
Yes.
So then it comes into the disclosure part here.
Okay. If the complaint was also in December, then it would be discovered.
Subsequently discovered fact, yes.
Okay.
If it is not into your attention before the year end.
Okay.
Right. So first, in the audit engagement, fact that exists at the date of audit report, but that were not known at that time. It is not an event that occur after the report date or resolution of contingency that exists at that date. So these are the events which were already exist at the balance sheet date, but were not aware of the auditor. If new information come to the attention of auditor, so auditor should perform the following things. One is consult with the attorney, that is legal counsel or lawyer. Second is determine if the subsequently discovered information is reliable, exists at the date of the report, material to the report, and applicable to the report that is still being replied. If all the four conditions above exist, auditor should perform the following action. Auditor should take the following action. First is advise the client to revise and reissue the statement. So here, subsequently discovered facts are not only those facts which has been came into the attention after the balance sheet date but before the report release date, but it can be after the report release date also. Right? You have already signed the report and later on you come to know that company is going into a litigation, company is going into a bankruptcy, and there was some severe issue you might have missed to address. Right? So that kind of situation may also happen, right? Which come to your attention even after the report release date, even after you have already signed the report. So then what all things you need to do? So first is advise the client to revise and reissue the statement and auditor report. First thing, what you will do, you will be requesting the client to revise the financial statement and reissue the financial statement along with the new audit report. Second is advise the client for disclosure in the financial statement. That means in the revised financial statement, you'll be advising the client to make appropriate disclosure in the financial statement of the subsequent period. If the date of issue is imminent, that means about to happen, that means you got to know only on, let's say, 25th of February and report date is 28th of February, right? In that case of scenario, you'll be requesting the client to disclose the respective fact as early as possible into those financial statement. Notify the person relying on the statement. For example, if the original report has already been issued and subsequently you got to know certain CPA fact. So in that case of scenario, it's been your responsibility to notifying the person who is relying on the statement. That means, for example, your audit report along with the financial statement, which are not true based on the subsequently discovered fact come into your attention. So it's been your responsibility to notify to all those parties whom you know would be relying on the financial statement which you have signed, like a banker, shareholder, creditor, right? Discuss with the Security Exchange Commission and other regulatory body if appropriate. For an issuer company, if you come to know any subsequent event which is subsequently discovered fact which is very much material to the financial statement of the issuer and for which 10K has already been filed. So in that case of scenario, you need to understand the severity and if needed, then need to discuss with the SEC for the revision of the 10K. Make sense? Yeah, Gurmehar, Sanchit, Kush.
I have a
Yes,
doubt.
sir.
Yes.
Yeah, Ayush.
Yes. So in the previous paragraph, we were like discussing that the date is about to come, like it is to be signed in 2 days. Okay. So if we come to know before that, we can we have still not issued the report
Yes.
or anything.
So
Then
there are two part. One is like from 1st January to 28th February, things comes into your attention. So in that case of scenario, you can request the management to revise the financial statement and sign on the updated financial statement.
okay.
Second scenario is when it comes after the signing date to your attention. So in that case of scenario, you'll be requesting the management to revise the financial statement and change the audit report. And wherever you know the parties are relying on your financial statement, which you have signed earlier, it's been your responsibility to communicate them that this is the subsequently discovered fact and we are revising the statement. Please do not rely on the earlier statement. And in case of a listed company, then you need to consult with the SEC for the revision of the 10K requirement.
Okay.
Right? Make sense, everyone? Sanchit, Kush? Okay. So
So if
now,
management has the intent to conceal the documents and not tell us the exact picture, so they might tell the information at a very later stage, like near to the report signing date, where we have very limited time to go through the documents and revise the financial statements.
yeah, subsequently discovered fact are majorly those where management intention is not right, because like it's not possible that management do not know there is some risky things is going on within the company, right? If it is material. So most of the cases subsequently discovered fact are those comes to the attention of the auditor later, which management is already aware. So here in this case, very good point, Sanchit, you bring into the attention. Here in this case, you need to look at like overall audit strategy and plan as well upon the management overriding of control, risk of fraud, or management intention to conceal the information. So that may have pervasive impact. But for example, if it is not a pervasive impact for, let's say, a specific financial statement line item, let's say for a specific litigation, management has not informed you. So in that case of scenario, which has come to your attention before the signing date, then you can request the management to do the appropriate disclosure and accrual if needed. But if it is coming after the report release date to your attention, so then in that case of scenario, and if management do not agree to make the change, then you can say management, please do not issue my audit report along with your financial statement to any one party whom you are sending, and wherever you know those party are relying, so it's being your responsibility to communicate that I am disassociating with this financial statement. Please do not rely on the report which we have issued because of this subsequently discovered fact which are material to the financial statement.
Sir,
Mhm.
a question. So usually, will this only happen in cases of liabilities? Because income and asset people would not try to hide. Expense would not have that kind of an impact on the subsequent case.
No, it can be on sales also. Maybe like company has inflated sales, but later on you come to know like customer was bookers, fake customer. So that can also be
Okay.
possible.
Overstatement of assets. Okay.
Mhm.
Sir, just one point. So subsequently discovered fact. So basically, whenever we audit,
Mhm.
whatever material differences or misstatement we notice,
Mhm.
most of them will fall under a subsequently discovered fact or no, not.
Uh,
So
not.
if there is any misstatement in their
Mhm.
accounts, so
Mhm.
that will come under subsequently discovered fact. I was taking it as a fact which was there, but management itself wasn't aware of that fact. That's
No.
why they did not mention that in their financial statement.
Yeah. Three things here, Gurmeer. One is like, for example, like those are you can say not in the attention of management, or those are not you can say significant for the management, or one those are not material to the management, right? So materiality is like what management consider and what you consider is generally more or less same, or management generally have lower level of materiality for their internal control purpose, right? If those things are not material, then you should not be bothered about it. Now coming to the second thing, when you're conducting the audit and you got to know some misstatement, so those misstatement will go into earlier one, correction of the misstatement or uncorrected misstatement, right? So if the management is agreed to correct it, it will take the impact on the financial statement, or it will make the appropriate disclosure requirement. If management does not agree to correct, it will go to the uncorrected misstatement. If uncorrected misstatement is above your overall materiality level, then you'll be taking the qualification. If it is below your overall materiality level, then you'll be requesting the management to give us in the writing in the representation letter. Now, coming to the third leg, which is like during your audit, what you have identified, yes, it can be subsequently discovered fact, or it can be misstatement, which we discussed earlier. But majorly those items which come after the signing date, how to deal with those items,
Okay.
right? Subsequently discovered fact are, you're right, it can be those facts which comes into our attention when we are performing the audit. Those misstatement, yes, those are also could be considered as a subsequently discovered fact, but majorly it will be those facts which come after the report release date.
And in that case, the most of them are the ones where management has the intention of hiding.
Yeah,
That is a normal understanding.
you can say most of the time.
So
Okay.
again, subsequently discovered fact, the intention needs to be checked, what I suppose.
Yes.
If the management was not intending to disclose that, then, and we were also not able to find it.
Yes. Because our
E-
audit always have detection risks. It's being like subject to samples.
But even if intention is not like intention was fine, but we got to know it after signing, that also we have to consider it, no?
Yeah. So if you have already signed, then you can, what you can do, you can request the management to revise the financial and take the new audit report to
Right.
share with the respective stakeholder. If management agree, then it is fine. If management do not agree, then what you will do will be communicate to those party whom you know would be relying on the financial statement and your audit report,
Okay.
right?
Fine.
So, sir,
Cool.
we will be communicating to those charged with governance or all the
Yes.
stakeholders?
Yes, we will be communicating to those charged with governance, management, stakeholder, creditors, lenders, or maybe future investors with whom we believe might be relying on the financial statement which we have issued.
Okay. So, but if we are doing audit of listed company, so
Then
there
you
would
need
be
to
some,
update the SEC.
yeah. So then SEC would be coming into picture now, because
They will give
there will be
public
certain laws and
notice.
regulations.
Yeah, they will give public notice.
They will give public notice. Okay. So
Yes.
it will be coming as our responsibility, or how would we be
Our
documenting and
responsibility is to communicate to the SEC.
okay, that
And then
we have
SEC,
discovered.
yeah, SEC will approve you to issue a public notice. Then you'll be giving a public notice in like national or international news.
Okay. Because as a CPA firm, then will we be getting any kind of penalty or so? Like if we have discovered and management is not changing.
Yeah, it will come into review. It will come into review. They will love to see what more you have missed and whether you have performed like audit diligently or not. You know,
Right, right.
you're inviting trouble and
Okay, okay, okay.
yeah. Practically, yes, you're inviting a trouble. But theoretically, it's being your responsibility to communicate, right? Otherwise, it will may have more severe impact on your integrity and objectivity as an auditor.
Right, 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 right.
Okay,
Thank
so
you, sir.
disclosure should be precise and factual statement of facts as known by the auditor and effect on the financial statement. So these are the disclosure required. If client refuses to incorporate the disclosure of fact, first, disclosure by the auditor in his report cannot be precise, and report should contain a statement that the client has not cooperated, right? So disclosure of the facts, information and number is being the responsibility of the management to be disclosed in the financial statement. In auditor report, you generally do not communicate the numbers. There you'll be communicating that management has not cooperated for considering of this subsequently discovered fact, right? Second is auditor should notify to the client that the auditor's report cannot be associated with the statement. So here you'll be sending a notification to the client wherever you are sharing your factually incorrect financial statement, please do not attach my audit report, right? So that notification you need to formally communicate to the client. Third is notify the regulatory body like SEC, income tax departments, state tax, municipality tax department, and other regulatory authority. Fourth is notify to each person known by the auditor will be relying on the statement. So if you know like lenders are relying on the financial statement, shareholder, prospective shareholder are relying, then it's being your responsibility to notify them. So this is about audit engagement, subsequently discover fact, how to deal with subsequently discover fact in the audit engagement. Now coming to the review engagement. If subsequently discovered fact become known to the accountant before the report release date, the accountant should be discuss the matter with the management and when appropriate to those charged with governance, right? Determine whether the financial statement need any revision, and if so, inquire how management intend to address those revision in the financial statement, right? If management revise the financial statement, perform the review procedure necessary. So for example, if management has made the required changes, then you need to perform the review procedure on the revised financial statement, right? The accountant should also either first date on the revised report as on the later date or include the additional date, dual date signing. So here two things possible. One is like, for example, you are doing limited review for, let's say, quarter ended June 2021. For that, let's say your report release date is 28th of July 2021. So at that point of time, you do not know any additional fact, but in the month of August, you got to know new facts. And you requested the management that previous review report, which I have signed, is incorrect. Request you to update the reviewed financial statement and allow me to update the revised review report, right? If management agree, then in that case of scenario, you have two options. One is you can take the same date and quash the earlier report and issue the new report, right? In that case of scenario, you'll be withdrawing all the original review report you have signed. You'll take back from the management and you'll be giving the fresh report of the backdated. Second option could be possible. You can give a dual date report. That means you can issue a second report in context with the original report also. So both things are okay. Make sense? Yes, no? Did you understand what is dual date report for the revision?
Yes, sir.
In the second report, you will give the reference of the original report for which you have audited everything or reviewed everything. Only this subsequent fact which come to your attention later has been reviewed subsequently later, and this report is in, you can say, extension of the original report. So here it will be two reports with two dates. Generally give reference to the notes.
Sir, in that case, we will be attaching our original report as well.
Yes, yes, yes. Yes, both the reports will go together. Generally
And
give
this will-
reference to the, yeah, yeah.
It will mark as extension to the original report. Yes.
Yeah, generally it's sent as a dual report.
Okay.
So generally give reference to the notes to the financial statement considering the impact of that revision. If management does not revise the financial statement, accountant should notify the review report to the as appropriate, right? So here you can take the qualification, modification in the review report. If the management does not agree to revise, if subsequently discovered fact become known to accountant after the report release date, the accountant should discuss the matter with management when appropriate to those charged with governance, determine whether the financial statement need any revision, and if so, inquire how management intend to address the matter in the financial statement. If management revise the financial statement, the accountant should review the financial statement. If before revision financial statement shared to third party, then should timely inform to the situation to all third party. If management does not take necessary step, then accountant should inform management and those charged with governance. If despite of such information, management and those charged of governance do not take necessary step, then accountant should take appropriate action to seek to prevent the accountant review reports to the third party, right? If management does not revise the financial statement, the financial statement has not disbursed. For example, management is not revising the financial statement and the financial statement have not yet disbursed to any third party, then inform the management and those charged with governance that do not make reviewed financial statement available to the third party without any revision. If reviewed statement has already been distributed, right, then inquire the step taken by the management to inform all those third party the revision requirement. If management does not take necessary step, then accountant should take appropriate action to seek the prevent use of accountant report, like consult with legal counsel, inform third party, inform regulatory authority, and so on and so forth, right? So similar to like audit, right? Things which you need to do for the review engagement. Now coming to the last piece, attestation engagement. What are the attestation engagement?
Examination, review, and agreed upon procedures.
Right. So attestation engagement, accountant has no responsibility to detect subsequent event. Right here, you have been given specific facts. You need to examine this assertion. You need to examine this account balance. You need to review this account balance. You need to review this class of transaction, or you need to perform those specific agreed upon procedure. So here it's not responsibility to detect the subsequent event. Accountant should inquire of responsible party as to whether they are aware of subsequent event, but they are not required to perform any additional audit procedure, and take a written representation about subsequent event from the responsible party. If the accountant become aware of any event where disclosure is necessary to prevent the user of the report from being misleaded and information about the event is not adequately disclosed, the responsible party in the subject matter or in its assertion of the accountant should take appropriate action. So 2 questions and then we are done with chapter 4. Ready for these 2 questions? Or you're
Yes, sir.
feeling sleepy,
Yes, sir.
man?
No, sir. Now we are excited.
Yeah, excited.
Extend
Okay,
the class,
so
sir.
excited. So question number 1, who the auditor need to notify in case client refuses to cooperate in disclosing the fact concerned with the subsequently discovered? To IRS, to client, regulatory body, each person known by the auditor to be relying on the statement.
Sir, fourth होना चाहिए.
Need not notify.
No, need not.
अच्छा, need not notify.
Sir, option 1.
So it's
IRS.
IRS.
IRS, हाँ. Not
Yeah.
रह गया.
तो
Excitement.
यही होता है
ये
एग्जाम
नंबर
टाइम
गया.
में.
नंबर गए.
That's what happened in exams time, you know. You slip one word and it will change the overall intent of the question. So you'll be discussing with the management, you'll be discussing with those charged with governance, you'll be informing regulatory body and to those third party who is relying on the statement which is in your attention, right? So all 2, 3 and 4 are correct. Only the first one is incorrect. You are not specifically going to IRS.
Right.
With regard to subsequent event, which of the following procedure should an auditor typically follow? Which audit procedure should an auditor typically follow? Compare the latest available interim financial statement with the financial statement being audited. Send the second request to the client customer who failed to respond. The confirmation, communicate material weakness to internal controls to the client audit committee, review the cut-off bank statement for several months after the year end. What do you do generally? There might be some answer may looks right, but you need to select the best right answer here.
So like it's first and fourth, but yeah, first is more appropriate because interim, while preparing interim financial statements, bank cutoff statements have also been checked while preparing the interim.
But how long you test cutoff?
It's only in the bank cutoff is at the year end basically.
So what is the fourth statement?
It says several months after the year end.
Do you do cutoff several months after the year end?
No, sir. Only
No.
first couple
Only-
of weeks of 15 days usually.
Right? That's an inefficient part if you do so. Why not second and third?
So
because-
second, we any which ways don't do normally. So if we don't get a confirmation, we don't again send a confirmation back to them. We do alternate procedures for that.
And third one?
It does not impact, like that's not something we would generally do to communicate material weakness.
We don't communicate material
And
weakness.
this would happen only after we have we are kind of done with the audit piece.
Right.
So
Yep, perfect. Makes sense. So we are done with chapter 4. So here is like you can say substantive audit procedure. I put here as an annexure for the respective financial statement line item. You can take a read, so it will be good for your information purpose.
These are sir assertions.
These are like respective activities or audit procedure you need to perform for the respective assertion in the respective financial statement line item. Right, just read through. If you have any doubt, we can discuss before starting of the new chapter. So these all are like, you know, basic journal auditing procedure kind of things. Right. So we are done with chapter 4. Next week we'll be starting new chapter, last chapter, which is 5th chapter, conclusion of the audit. So in which we'll be learning preparation of the audit report, which is also very important topic, both for your exam purpose as well as practical life purpose. You should know how to draft an audit report, how to draft a review report, how to draft attestation report, agreed upon procedure reports, group audit reports. So all those things we'll be learning in next chapter. Right? Any doubts so far on chapter 1, 2, 3, 4?
सर 1 2 3 4 मुझे लगा 4 ही पूछोगे अभी तो
accumulated.
तो हमने कंसोलिडेटेड बना दिया है।
हाँ मैं तो बड़ी टेंशन हो गई मैं क्या अभी तो but so far this chapter is good sir.
Cool. Okay. Enjoy rest of your Sunday. We'll see you on next Saturday with new chapter.
Okay,
Thank you so much, sir.
thank you.
Thank you, sir.
Bye.